My name is Jake, welcome to the channel. In today's video, we're gonna do a Review My Pie video where I review subscriber portfolios. I don't know about you, but the last couple of months have been really hectic and chaotic in the stock market. If you're invested in the stock market, you probably have less invested today, or your portfolio is valued less than it was 6 months ago or a year ago. The whole market is kind of going through a weird shift with the Fed increasing and raising interest rates. It's a kind of a weird time. And so if you understand why you're invested, and if you have a long-term time horizon and you don't plan on liquidating or living off of your portfolio anytime soon, this is one of the best things that could have ever happened to you. Okay. And so something that I want to share with you, what's been helping me mentally cope with the market volatility, is I'm thinking to myself, well, if nothing has changed, right? You look at the investments in your portfolio. You look at this, let's say, for example, with Costco, right? Costco is performing pretty poorly in my portfolio since I purchased it. I bought into Costco at a little bit of a higher price, but I'm averaging in dollar cost averaging. But the thing about Costco that I try to ask myself and remind myself, well, Costco was trading for over $600 a share not too long ago. And now it's trading for under $500 a share. And so I asked myself, well, would I rather own or buy more shares at $600 or at $500? Well, duh, dummy. Obviously, I want to buy it at a cheaper price because, that whole buy low, sell high. Yeah, I don't think you don't have to be a genius to understand how that works. So obviously, buying cheaper is the smarter move. It's better. But for us human beings, us normal people, it's just, I guess, a mental tax on a lot of us when we think about that, right? We don't like seeing our portfolio in the red. It's just it's just a psychology thing. Let me give you another example. Matt Damon. Fabulous transition. Matt Damon, look at Matt Damon. The guy, fortune favors the brave, yada, yada, yada. Matt Damon has an amazing blue jacket. A year ago, for example, this blue jacket probably cost, I don't know, let's give an example, $5,000. Let's say Matt Damon paid $5,000 for that jacket. Let's say today, not including inflation, blah, blah, blah. Let's say, for example, he was able to buy this same blue jacket for $2,000. What do you think Matt Damon would rather do? Would he rather pay $5,000 or $2,000? Now, given crypto is in the dumpster, he probably is going to want to go with the $2,000, right? So think about that with you. If you're wearing a sweater or a t-shirt, would you rather pay $10 or $50 for the exact same t-shirt? Is the exact same concept when it comes to your investments. When you think about the businesses that you own, assuming that nothing has fundamentally changed, wouldn't it make more sense to buy more when it's lower? So that's what I've been doing to mentally kind of cope with all of this chaos that we're seeing here in the market. Because investing in the stock market in 2022, it's kind of felt and looked a little like this.
Here, Jack, I found you a thimble.
Oh, thanks, Uncle Arthur. I drew you a picture. It's by your...
Thanks, kid.
Oh my gosh. All right. Okay, cool. So in today's Review My Pie, we're going to answer one subscriber question. The first portfolio is going to be from a 54-year-old here in the US. The second, a 23-year-old from Australia and Australia. We'll leave it, whatever. And then the third, a 27-year-old from the United States. The timestamps are going to be in the description below, as well as the portfolio links will be in the description below. And as always, everybody, I'm not a financial advisor. Don't take what I'm saying as financial advice. It's just merely for your entertainment. All right, let's take a look at the question here from Norbert. He writes, "Hello, Jake. I hope you're doing well." I am doing well. Thank you. I'd like to have your opinion. I have $50K to invest in my dividend portfolio. My question is, continue dollar cost averaging or lump sum investing, including those premium companies like AbbVie, Johnson & Johnson, etc., or buy only the companies that have fair discounted value like JP Morgan, Starbucks, 3M, etc. Have a great weekend. Norbert. Well, Norbert, thank you so much for the question. I think really when it comes to this, in my opinion, you really got to do what makes the most sense for you. I personally like to dollar cost average. In general, everyone's situation is going to be a little bit different. If you come into a large sum of money, and that large sum can be different for every person, if you're hesitant to invest all at once, you can, for example, Warren Buffett and Jack Bogle, the investing greats out there, they get asked this question all the time. And I've watched a lot of videos on what they've shared and what they've said is the most likely outcome or the best choice for most people. The sooner you can get your money into the stock market, in most cases, the better you'll be over the long term, right? And so the market goes up more than it goes down over the long term. And when we talk about long term, I'm talking decades. So if you're ever concerned about, okay, I've come into some money, what do I do with it? What you could do is you could invest over a couple of months, a couple of quarters. If you're really concerned, you can invest half now. You can invest the other half a year from now. There's really no just one size fits all answer. And so the way that I like to view it is I like to focus on time in the market and not time the market. Do you understand that? So the sooner that I can get my money in to cash flowing businesses like AbbVie, Johnson & Johnson, 3M, et cetera, I feel that I am going to come out ahead over the long term and not be on the sideline waiting. Okay, so that's kind of how I approach this. My opinion is to dollar cost average. If you do come into a large sum of money, you can either lump sum all at once. You could break it up into, quarters. For example, you could invest half now and then the remaining half over, a year's time span, 6 months, 3 months, whichever you would like. So that's just kind of how I view it. And that's just my opinion. So I hope that helps. And thanks for the question. All right, the first portfolio here is from James. He writes, "Hey, how's it going? This is Dividend Driver. I figured I would submit my portfolio to see if you would review it. So some background, I'm 54 and I plan on retiring at the age of 67. I currently invest 30% of my paycheck every week. Thanks." Well, hey, James, thank you so much, man. I read your comments every single week. Thank you so much for following the channel. I think you've been following the channel for over a year. So really, really appreciate you commenting on the videos. I always get excited when I read your comments. All right, let's take a look at your portfolio. So this is your portfolio. It doesn't look like the history goes all the way back. You probably have like a covered call ETF in here, or you have an IPO company in here. So if you don't see this back 5 years, it's because you hold something in here that's blocking it from going back. Your dividend yield is, you have a strong dividend yield, you have a decent expense ratio. You probably have covered call ETFs in here if the expense ratio is that high. 65 holdings is definitely on the higher end. You're probably, if your portfolio is down over the last year, you're probably skewed heavier towards growth. But what's interesting is you have a 3.6 dividend yield. So there's got to be covered call ETFs in here. Okay, so you got it broken up into 40, 34, 13, and 13. Let's take a look at your core. All right, let's see what you got in here. Okay, so you got 10 holdings, 5% dividend yield. Yep, a pretty high expense ratio. You got VTI, this is the total US stock market. You got Devo, okay, cool. You got JEPI, you got VXUS, you got VNQ, you got NUSI, you got QQQ, you got QYLD, XYLD, and BND. Okay, I kind of like this. I like it. I think there's a lot in here. So here's the cool thing. Every single one of these ETFs, in my opinion, they're kind of best of breed. Right? You have the best total US stock market. You have a very high quality covered call ETF in Devo, right? You could add, for example, like an SCHD or a VYM that would be more of a traditional dividend ETF. But Devo it's a pretty good, I talked about this one in my last video. It's a pretty popular cover call ETF. JEPI, really a high quality cover call ETF. VXUS, this is my favorite international ETF. I own this in my Roth IRA. VNQ, one of the best real estate ETFs. I own this in my Roth IRA. You got NUSI in here. You got QQQ. So there's a lot in here. And so here's the thing that what I'm kind of interested, or what I kind of like is, yes, you have 10 different types of ETFs in here. But the cool thing is every single one of these ETFs is different. They really are different. The only ones that are kind of similar is NUSI and QYLD. Those are kind of similar. And then you have XYLD and then JEPI. Those are also kind of similar. Well, they're very similar. NUSI is unique because it has a collar strategy. I'm kind of mixed on NUSI. I personally made some updates here in the past. I went with just QYLD, but in theory, NUSI is intriguing. It kind of saves you from that Armageddon scenario. But yeah, so I do actually kind of like this. If you're going to invest into so many ETFs, it's important that you understand why you're investing into them. But I'm trying to think to myself, is there a way that you could simplify this and make it easier? Really, the only thing that I can think of, really off the top of my head, is you could consolidate XYLD and maybe JEPI. Those are both focused on the S&P 500. NUSI and QYLD, do you really need both of them? I don't know. But here's the thing. You mentioned that your time horizon, so you're 54 and you have over a 10-year time horizon. This is where I'm actually going to backtrack a little bit and say there's a few things that you can do to optimize this. For example, when you have cover call ETFs in here, you really are capping the amount of growth that you can get from the portfolio. And so if you have over a 5-year time horizon, I generally would think it would make more sense to focus on growth. And you're going to get that growth from VTI, for example, and QQQ. So in my opinion, limiting the amount that you have to cover call ETFs if you have longer than a 5-year time horizon. And it looks like you have, I think, over a 12 or a 13-year time horizon. So in my opinion, I like that you have, if you're going to have QYLD in here and XYLD, having these at a lower percentage, I like that. What you could also consider is potentially even lowering NUSI. That could also make mathematical sense, because if you have 12 or 13 more years, you want to focus on growth and accumulating the growth. You don't want to focus on preserving your wealth, right? Unless you are coasting fire, it probably makes more sense. And for people watching, it makes more sense if you are accumulating wealth and you're building wealth, you want to focus on growth and not wealth preservation. Because if you're looking to grow wealth, why do you want to preserve it, right? I remember having this conversation with a family member. This was, I think, 5 or 10 years ago. And I was talking to them and they're like, yeah, you got to invest into gold. And I'm just like, but isn't gold really meant to preserve you wealth and like act as like a hedge? And I'm thinking to myself, I don't need to preserve wealth. I don't even have wealth. I got to generate wealth, right? And so once I understood that, you don't really want to invest into something that's going to quote unquote preserve your wealth, when at this point in your life, you should be focusing on accumulating wealth. And that's why I would consider, kind of putting a question mark on NUSI, maybe a little bit of a question mark on JEPI and DEVO, and lower those potentially and focus more on ETFs that are going to grow more over the next 12 and 13 years. So for a 12 and a 13-year time horizon, I like SEHD, I like DGRO, but SEHD is probably my favorite. Okay, but those are some thoughts there. As the ETFs themselves, they're great. You just have to optimize them, in my opinion, for your time horizon. Individual stocks, there is a handful in here. There's 25. Okay, here's your SEHD. I guess, yeah, okay. Let's see here. JP Morgan, Home Depot, Pepsi, some blue chip companies in here that most of us have heard of. Yeah, these are all really, really high quality companies. Now, if you were investing into speculative companies that maybe nobody of us have ever heard of, I would say 25 is a bit much. But because you're investing in a Home Depot, Pepsi, McDonald's, Duke, Costco, Microsoft, like you can invest into this amount of companies if you're investing into these type of companies and sleep well at night. I think these are fine. Personally, I think most people 25 is going to be on the higher end of individual companies, but you know, that's fine. 17 REITs. There's quite a few REITs in here. What do you got in here? Realty Income, Stag, Simon Properties. Okay. Some really good names. Good. Extra Space. So a couple of thoughts here. I hope, with your age, you said you're 54, this should ideally be in a Roth IRA. So if you're investing into a Roth IRA, this is an ideal place to hold REITs because you're not going to be paying taxes on it. So the type of REITs that you have in here, I think these are good. These are all fine REITs. My favorite REITs, I really like Realty Income. I'm not the biggest fan of having it at 20%. I mean, I like MPW. I like American Tower, Crown Castle, DLR, Prologis, all really great. These are all really, like half of these I own. I own good in my portfolio, Extra Space, Public Storage, WPC I own, Omega, MPW, American Tower. Like I own every single one of these. Stag, Realty Income. For the most part, these are all really great REITs. Growth, what do you got in here? You got NVIDIA, NEO, BABA. Okay. All right, well, cool. Now, I'm sure that this, yeah, I can imagine, hot dang. This portfolio is down, but if you're investing for the next 13 years and beyond, this is a great portfolio to dollar cost average into, right? This is the future. So here, think about this. This right here, this is your kind of your steady eddy. This is going to be your core. This is going to help stabilize your portfolio. These companies are not going to go anywhere anytime soon. But Johnson & Johnson, Procter & Gamble, Caterpillar, they're not growing anywhere as fast as the companies here in this slice. So yeah, I really like having growth in here. I like having the stability in the type of companies that you have in this slice. Well, some final thoughts, James. I like that your portfolio is structured in a way that you can understand it. It's, you know, judging by how active you are in the comments, I know that you're very involved in the topic. I hope that this isn't a tax sheltered account for you, especially with the REITs and with the cover call ETFs. The dividend is, you know, it's not always as favorable as qualified dividends. Maybe revisit those cover call ETFs and the strategy behind your cover call ETFs. And if you do that, I think your portfolio is going to grow faster and compound faster. And then what you can do is once you get closer to retirement, you can then shift and focus more on cover call ETFs. And another thing, I don't talk about this a lot, but if this isn't a Roth IRA, what you can do is by focusing more on growth earlier in retirement, what you can do is you could sell out of the growth names, right? Hopefully, assuming that these have compounded and grown faster, then what you can do is you can rebalance and then you can buy with more money into the cover call ETFs. Just something to consider, something to think about. But yeah, I hope that that's helpful. Thank you so much for sending over your portfolio. All right, the next portfolio is from Jordan. He writes, "Hi Jake, my name is Jordan. First off, I love the videos in the series." Hey Jordan, thank you so much, man. I appreciate it. I'm a 23-year-old guy living in Brisbane, Australia. I joined the Army at 18 and was medically discharged in February of 2020 after a severe knee injury. I now run my own junk removal business here in Brisbane, which after the first year, I'm looking like I'll profit just over $30,000 after paying all expenses, including employees. Wow. With only more potential to grow in future years. To break down my intentions, 30 years old is my number. So that's when you want to reach fire. So in 7 years. Now I don't have to retire, but I'd like to be financially free to start new businesses, travel, enjoy life, whatever it may be. Now I know with kids and a family, this is going to get significantly more expensive, and I'm okay with that. Like I said, I don't want to retire, but a goal of supplementing my needed income through investments is my plan. I currently have a dividend portfolio worth $44,000 between US and Australian stocks. I've just bought my first rental property for $300,000 at 20% down, leaving me with $240,000 and a 2.2 interest rate. That is incredible. You're 23 years old. You just bought a house. You have $44,000 in dividend stocks. What? Okay. Like, holy cow, man. When I read this, I just like, I almost get a tear in my eye. I'm just like, damn, what was I doing when I was 23? I know what I was doing. At 23, I was playing StarCraft. That's probably what I was doing. Or WoW. Or CSGO. That's probably what I was doing. Dang, man, that's awesome. Between my business, the rental income, and some other smaller side hustles, I'm able to contribute $1,200 to my investments per week. Most of this goes into my dividend portfolio to start raising that income. As like I said, my time frame is a little over 6 years for me to be making a goal of 50% of my required living costs through my investments. I'm wondering if you'd recommend me using the $1,200 for anything other than dividends. Should I pay off the mortgage sooner? It's only a 2% interest rate, not a huge loan. I already reinvest 15% of profit back into the business each week before my take-home profit. I also have around $6,000 in crypto. Judging when you sent this email, you probably have $1,500 in crypto, just for diversification. I love any and all advice. Cheers, Jordan. Well, Jordan, this is so awesome, man. So, man, I probably could be taking advice from you, given where you're at 23 years old. I don't know what you guys are drinking out in Brisbane, but you're much more financially literate than I was when I was 23. Okay, a couple of things. First off, when it comes to paying down the loan, unless you're a Dave Ramsey fanboy, I would not pay off your loan. I'm not, especially with a 2.2% interest rate. I think you would be absolutely insane to pay your mortgage off early. It's just, for me, with inflation and everything, I think it's the smartest thing that you could possibly do at your age, with your income, with your situation, is use the bank's money. At a 2.2% interest loan, unless you get anxiety and you can't sleep at night because of debt, then that's a whole nother question. But a 2.2% interest rate, I think you're in a fabulous position. So for me, it's a hard no. I would keep it. I would invest everything into your business, your rental business, other businesses that you're doing, dividend stocks. And also one thing as well, this is not something that I talk a lot about, but one of the things that I do not regret from my 20s is traveling. I went to Egypt. I went to Thailand. I went all over Europe. I didn't invest as much money as I should have, but I am so thankful that I was able to travel before my knees started to crack and, my back started to hurt. I'm only in my mid-30s, but my back started to hurt. But here, honestly, you're in an amazing position. Don't forget to celebrate, don't forget to remember what's most important in life. Your time is what's most important in your 20s. Like, that's the one thing that I do not regret from my 20s, is traveling and getting to see different cultures and different things. So I would highly encourage you, or anyone, if you're in your 20s, don't go too crazy about this whole hustle culture, right? Hustle culture, it's important, but you also still want to enjoy your life. And, not to sound cliche, you only live once. All right, so let's take a look at your spreadsheet here that you sent. It looks like you got 14 individual companies, and a lot of these I am not going to be oh, there we go. Okay, you got different ones here. So you got your Australian ones and you got your US ones. Okay, so I'm not going to really be able to say much about the Australian ones. I think it's cool that you're investing into Australian companies, local businesses that you're probably more familiar with. I think that's cool. But let's take a look and see what you have here in the US. You got Apple, Energy Transfer, okay. Intel, Kimberly-Clark, Coca-Cola, 3M, Nokia, okay, Realty Income, AT&T, Pepsi, McDonald's, Caterpillar. Okay, so the cool thing here is you're in a unique position where you can set up your portfolio in a way that it meets your goals. And so I don't know how the tax structure works in Australia, but for example, with AT&T, with Coca-Cola, right, or with Realty Income, these are you're getting a higher dividend. You're sacrificing growth for the income today. This could be a good thing. It could be a bad thing. When you're thinking about building out your portfolio, and it sounds like the dividend portfolio is and you mentioned this, to supplement your income. It's not to fully retire off of it. I guess it actually kind of makes sense as a 23-year-old to invest into Kimberly-Clark, to invest into 3M, Realty Income, Pepsi, etc. So it sounds like if you're looking to live off or supplement your income or your living expenses with a dividend, having these type of slower growing companies or ET, for example, in the portfolio can definitely make sense. Generally people think, okay, I'm 23 years old. I'm going to work for the next 30 years. So therefore I need to invest into Microsoft and Apple, and that's it. That's not how it works if you want to do it right. If you think about it, your time doesn't matter. What really matters is when you plan on no longer reinvesting the dividend, no longer funding the portfolio, but rather taking the dividend out of the brokerage and paying your mortgage, paying for your food, etc. That's the key thing here. Given that, I think this is fine. One of the things that I would highly encourage you to consider, what do you got in here? You got your Bitcoin in here? Okay, cool. Something that I would definitely consider is potentially, consider an ETF. Whether that be a cover call ETF, I think that would be something right up your alley, like a JEPI or maybe in a couple of years, you could even consider a QYLD in the future, right? But that's something you could consider. Also, I think something that would be right up your alley. Can I type on this? Nope. Consider like an ETF like SCHD, right? That would be something that I would definitely consider if I was in your shoes. But yeah. So that's just kind of my feedback there. I think your story is so incredible. I'm so excited for you. So yeah, man, you're doing great. So the best thing that I can tell you is continue to educate yourself. Don't forego experiences. Enjoy your life while you're doing this, and enjoy the journey. That's all I can say. All right, let's take a look at the third portfolio here from Hassan. He writes, "Hello, Jake. Hope you're well. I wanted to first thank you for the work you've been doing. You've inspired me to be more intentional with my money and look long-term with my financial goals." Okay, cool. Kind of paraphrasing there. "I commented on your videos asking to review my portfolio, and you asked me to send you the information. Okay. A brief intro to me. My name is Hassan. I'm 27 years old. I moved to the United States 4 years ago after completing my master's from Germany." Very cool, man. Let me know where in Germany you were at. I was mostly in Bavaria. It's been more than 2 years now that I've started saving and investing. Nearly 60% of whatever I've earned, and just 2 weeks ago managed to reach my milestone of hitting $100,000 before the age of 28. That is incredible. I'm a business analyst. So you know how long it took me? My wife and I, we hit our portfolio, like actual portfolio value, not like in real estate or anything. I think we were like 33, 34, something like that. I can't even remember. That is 33, I think. That is incredible, man. That's so awesome. I'm a business analyst and work at a fintech company. I make about $78K per year. My next big goal is to become a millionaire by the age of 2030. I generally do low risk investing, so ETFs like VOO, VIG, VYM. Okay. I have a 3-month emergency fund, and Dave Ramsey's going to love you. Besides M1 Finance portfolios, I also have allocations in a 401k, Bitcoin, Ethereum. I'm consistently making effort to increase my income so that I can invest at least 50% of my net income. That is incredible. I love it. When you're thinking about financial independence, it's about making more money, but it's also about reducing your expenses. And if you can increase your savings rate, the amount that you're investing from your income, it's incredible. I've made a few mistakes with M1 Finance pies as I have duplicated your ETFs, and I really need someone to give me feedback on how to improve them. I have 4 accounts with M1 Finance. You have a general tax account, you have a Roth account, traditional IRA, you have a high volatility general investing account. Okay, well, cool, man. So it sounds like you are really, really in the weeds. You work as a business analyst at a fintech company, so financial technology company. You did your master's in Germany, so you're probably analytical. You're probably like an engineer or something to that degree. So you're probably thinking about how to optimize things and you want to make it as efficient as possible. Sometimes, you know what I've noticed over these last couple of years? I've noticed that the more we try to play around with things and kind of over-engineer things, the more complicated it can be. You know what it's kind of like? It's like when you're driving to work, right? You're driving in your car and then you see some crazy wacko going in and out of lanes and they're going from one lane and they're swerving into the next lane and you're just like, dude, calm down, take a chill pill. It kind of, when you invest into, your portfolio and you have a whole bunch of different strategies and you maybe kind of overcomplicate it, it's kind of like that where you're swerving between lanes when in reality, you're not going to necessarily get to your destination much faster. Okay, that's kind of how I view this when it comes to investing. Sometimes you don't have to overcomplicate things to get really the best possible result. So keep that in mind. All right, let's take a look at your portfolios. You got 4 here. This is your taxable account. The portfolio history is not very far back from this year. Do you have okay, I don't know what that is. All right, so you got a pretty decent dividend yield. All right, so I'm going to try to go and give you as much feedback as I can here. So you got Betterment, My First Pie, Acorns, all sectors. Okay, what do you got in here? Whoa, you got VTV, good ETF, VTI, VEA, VWO, VOE, VBR, BNDX, VTIP, TFI. Wow, there's a lot of ETFs in here. All right, let me show you this here. Let's go to ETF.com. Let's take a look at VT. VT is something that I think is going to be something you may want to consider. It doesn't have the highest dividend yield. It has a 2% dividend yield. What is your dividend yield? You have a 2.4. Okay, you have a 2.4 dividend yield, and this just in this slice, right? VT has the exact same dividend yield. It has a low expense ratio. What's your expense ratio? The exact same. So what you could do, and look at this, it has 9,000 companies in this ETF, all right? And so what VT is you're invested into the top countries here. You got United States, Japan, United Kingdom, Hong Kong, Canada, France, et cetera, et cetera. You got companies like Apple, Microsoft, Tesla, Alpha. So the largest companies are US companies, so it's based off of market cap. But the key thing here is you're getting the exact same thing with this one ETF that you're getting with 13 companies. 13 ETFs, excuse me. But I know I also understand you have treasury and you have inflation and bonds in here as well. So that's something that you could consider. You know how I was talking about with the cars swooving in and out of lanes? In my personal opinion, it just makes it so much easier if you declutter not only your life, your house, but also your finances. So this is something that I would definitely consider. Consider as an alternative to this, simply going with a total world ETF like VT, just as an example. Okay, so what do you got here in your first pie? You got VOOV, you got VOIM, you got VOO, DGRW, really cool ETF. This is I actually like this ETF. This one's a little bit different. VNQ, VTI, VOOG, VYMEI, VPU, BND, Tesla, this is a lot of stuff. Okay, so I'm not a big fan of this. I think this is just overcomplicating it. I don't think you need to do this. Understand your strategy and make your life simple. This does not make your life simple. Even though you're only invested into ETFs, well, you do have a few individual companies in here, though you're invested primarily into ETFs, there's a lot of clutter, right? You got the value, you got growth. You got international dividend, you have US dividend. You have utilities, there's a lot of stuff in here. What I would encourage you to do is take a look at this list and think to yourself, okay, what do I really, really want, right? What are maybe the top 3, 4, 5 ETFs that I want? And then maybe focus on those first. You mentioned that you're just starting out. It says that you have about $11,000 in this portfolio, okay? So in this portfolio, you have $11,000. You're not gonna get real exposure investing into these ETFs and companies if you only have 11,000, 20,000, 50,000, 100,000. I would pick 3, 4, or 5 of your favorite, and I would start there. And then as you educate yourself more about investing, as you learn more, then you can start to look to add a few more. What do you got here in Acorns? You got VOO. You got VOO in there quite a bit, it looks like. You probably transferred over your other accounts into M1 Finance. That's kind of what you did. You can transfer between slices. It's a little bit weird, but you can transfer. What you have to do is you have to create a buy and a sell order in the new slice, and that's how you transfer between slices in M1 Finance. All right, let's take a look at your Roth IRA in here. So it looks like your performance is okay. It's decent. It's not too crazy high. You got VIG and you got VOO. You have the Robo Advisor slice here from M1. Is this link going to work? I don't know why this is refreshing. It doesn't look like this link is working. I don't know why it's not working. It's not letting me go in there. Whoa. Yeah, this slice is not working for me. Something that I would definitely consider, if you're in your early 20s and this is a Roth IRA, you're not going to be able to access this portfolio until you're 59 and a half in most cases. So in my opinion, it makes more sense to focus on growth. When I see the word conservative in a Roth IRA from a 20-year-old, it just tells me that you probably aren't fully understanding the risk reward when it comes to investing. When you have over a 30-year time horizon, you want to go risk on in most cases. Now, obviously, everyone is in a different situation, and I can't speak for everyone, but mathematically, when you think about compounding returns over a long time period like 30 plus years that you have, when you're looking at this mathematically and based off of historical data, which is obviously never a guarantee of future returns, you want to skew more towards growth when you have a long-term time horizon. And when you're focused on a conservative investment in your Roth IRA, that tells me a couple of things. Either you're scared of the stock market and you want to be more conservative, which is fine, or you don't understand compounding and you don't understand the rule of 72. So that's what I would recommend you do if you're unsure of what type of investments you should hold in a Roth IRA and you have a 30-year time horizon. Google the rule of 72 and understand compounding rates, because you don't want to get conservative when you have a long-term time horizon like 30 years. Okay, so go Google rule of 72, do some research on it, and that should definitely help you when you're crafting your portfolio for a long-term time horizon like that. Let's see what you got here. Traditional IRA. Okay, so this is, I guess, is the opposite. The other one you got conservative. This one you got aggressive. You got a lot of accounts, man. VOO and you got VIG. Okay, is this one going to work? This one is not going to work. All right, so when we look at this one's up a little bit more. The aggressive one, I'm assuming there's probably some mixture of U.S., international, and bonds. So what we can do is, let me go into my M1 here really quick. Let's do Expert Pi. So what you can do is, if you have M1 Finance, you can go over to Research, you can go to Expert Pies, and here are these completed pies for you. Let's look at, I have no idea which one it is. Retirement, plan for retirement. Here we go. What did you have in here? You had aggressive. Okay, 2055 aggressive. Oh, wow. What the heck? Okay. So yeah, they have a mixture of international and U.S. Do they have bonds in here? Man, they've been listening to like Dave Ramsey or something. Okay. All right. I mean, I guess I'm not the biggest fan of these, to be honest. Yeah. Okay. So they're aggressive. That's what's weird about M1 Finance and these Expert Pies. They're quote unquote aggressive means that how much exposure there is to international and emerging markets. For me, that's just dumb. I don't know. Or I'm just dumb. I don't know. I don't like them. I'm not a big fan of these. This is the conservative one, right? 2055 conservative. International, VTV. Why not just get VT? Like, seriously, all you got to do, go like this, do VT, and then you have the US and international. I don't know how I do it in my portfolio. In my Roth IRA, I do VTI for the US, and then I do VX US for international. That's how I do my Roth IRA. So when it comes to this, when it comes to the traditional and the Roth IRA, I like that you're thinking about this and how you're planning, okay, how you're going to maximize these accounts. For me personally, I like keeping it super simple. In my, for example, my Roth IRA, I just have 4 ETFs. I have an HSA. I don't talk a lot about it, but all I own in my HSA is the S&P 500. That's all I own. I don't own these fancy bonds and international ETFs. I just own the S&P 500. Okay. And so everyone's going to have a different approach to how they want to invest. What I would recommend is look at your portfolio and see how you can make it as simple as possible. That's what I would say to this. So for example, you do have VOO in here, but you have it at 30% and you have other things in here. Keep it as simple as you can is how I would say it. All right, your last slice here, you got high volatility. It's so volatile that it broke the graph here. Okay, what do you got in here? You got 93 holdings, dividend yield, high expense ratio. This is on the higher end. ARK ETF equal weighted. Is that from M1? Is that an M1? Does M1 have an ARK? Wait, did that work? It did. M1 has an expert pie from ARK? What? Is this real? Let me take a look at this. Is that actually a thing? Do they have it? General investing response. It's definitely not responsible. Let's see. Other strategies. Oh my gosh, they do. M1 Finance actually has an expert slice or pie with ARK. Oh, those poor souls. Oh my gosh. WTF. I mean, okay. That's cool, I guess. All right. So you got the ARK ETF in here. So yeah, I mean, I hope you didn't buy here. Wow. Okay. I mean, if you believe in the Cathie Wood story, go for it. I think it's fine. I personally, I like my VGT. I like my S&P 500. I don't know. I'm not the biggest fan of them. Let's see. What do you got in here? Vanguard high dividend portfolio. What do you got here? You got VNQ, VOIM. Okay. I like this. I like this. I like this. I like this slice. This is a good one. Is this from... No, you created this. This is not an excerpt. Okay, yeah, you created this. You got Wix. You got Waste Management. Love Waste Management. Disney, Anthem. Okay. Yeah, this slice right here is probably in the dumpster. Oh, man. You're probably... If you've been in dollar cost averaging in this one, you're probably down 50%, 60%. Okay. But on the flip side, if you're investing for the next 10 or 20 or 30 years, I mean, as long as the companies don't go bankrupt, which I'm sure some of them will, or very likely they will, this could be an incredible time to average down, right? So, the whole be fearful when others are greedy when blah, blah, blah. You get the gist. All right, cool. So there's a ton of stuff in here. What do you got in here? SEH. Okay, these are good ETFs. Specialty, good. These look very similar to the ones that I had in mind. Yeah, I think this is my slice that I made a year ago. I do like it. It is a good one. Wait, did I? Yeah, this is I think the one that I had in my portfolio a while ago. Now, this is a good one. Those are good REITs. So you got some growth in here. You got the lemonades. I mean, look at that. I just like, wow. Yeah, I mean, it makes you rethink your life decisions, right? So when it comes to this type of strategy, you want to be definitely like, your emotions are going to be running high when it comes to this. So when I look at a slice or when I look at a pie like this, I look at this as money, just kind of fun money, right? You set it, you forget it. You invested in this market, you invest $100, a month later, you have $50. And you just have to be okay with that. And you have to understand that this is a long-term investment. And you do have to understand that it's very possible that there's a few companies in here that will no longer be around in 10 years, in 5 years. I mean, there's not a lot of them. There's a few of them that kind of stick out. But Like, for example, Amazon's not going to go anywhere. Well, Hassan, thank you so much for sending over your portfolio. Thank you so much for reaching out. I think the key thing here is I would try to make this as simple as possible. If there's somebody watching this video and they're new to investing, I hope that they understand that this is not the right approach for everyone. Okay? Investing should be boring, right? You hear about Warren Buffett, right? Investing should be boring. It's not something that's flashy and cool, right? Because then you have times like this where this happens, right? This is when investing is cool. This is when investing sucks and everybody makes fun of you because you got scammed, essentially. Like, you could call this a scam. Investing should be boring. It should be boring, and that's okay. Like, you look at Waste Management, trash, right? This is trash. This is the trash business. They pick up garbage and they charge people for it. This is the type of investing that I personally love. It's slow, it's understandable, it's cash flow positive. So really, the last final thoughts, try to simplify your investing. Really try to simplify the amount of companies and ETFs that you own. When you do that, more complicated is not better, especially when it comes to investing. The simpler you can make it, the easier, and in most cases, the better outcome you're going to get over the long term. Thank you so much for sending in your portfolio. Thank you so much for watching, everybody. I hope that you learned something new and you enjoyed the video today, and I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.